What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. So make sure you please subscribe. Please watch this episode from start to finish. I promise you will not regret it. Please note that anything discussed in this episode is not financial advice, so please do your own research before investing into any stock. In this particular episode, we're going to be talking about how I believe that Jerome Powell is going to provide a buying opportunity for the S&P 500 and for the stock market in general. On Tuesday of this week, Jerome Powell testified in front of the Senate Banking Committee, and he stated that interest rates are probably going to be higher for longer than what the committee had anticipated. This sent stocks down. The S&P 500 dropped over 1.5%, and the Dow Jones is now negative on the year because of those negative comments. I want to use this episode as an opportunity to put those things into perspective and why you need to be focused on buying stocks and building a position right now and not focused on what Jerome Powell is saying. Let's go ahead and get into it. Okay, everybody, so let's break down this article very quickly here, and I'm only going to go through the high points. Federal Reserve Chairman Jerome Powell on Tuesday cautioned that interest rates are likely to head higher than central bank policymakers had expected, citing data earlier this year showing that inflation has reversed the deceleration it showed in late 2022. The central bank leader warned of tighter monetary policy ahead to a growing economy. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. Powell said in remarks prepared for two appearances this week on Capitol Hill. If the totality of the data were to indicate that faster tightening is warranted, we will be prepared to increase the pace of rate hikes. Now, those remarks carry two implications. One, that the peak or the terminal level of the federal funds rate is likely to be higher than the previous indication from the Fed officials. And two, that the switch last month to a small percentage point increase could be short-lived if inflation data continues to run high. Now, in their December estimate, officials pegged the terminal rate at 5.1%. Current market pricing moved higher following Powell's remarks to a range of 5.5 to 5.75%, which is higher, but Powell did not specify how high he thinks rates will ultimately go. Now, restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time, Powell said. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. Powell noted that some progress on inflation for areas such as housing. However, he also noted there is little sign of disinflation when it comes to the important category of services spending, excluding housing, food, and energy. That is an important qualifier considering that the chairman at his post-meeting news conference in early February said that the disinflationary process had begun in the economy, remarks that helped send stocks higher. Markets mostly had expected the Fed to enact a second consecutive quarter point or 25 basis points rate at the next FOMC meeting later this month. However, Powell has spoke markets priced in a 69% probability of a higher half-point increase at the March meeting, according to CME Group data. Powell reiterated that rate decisions will be made meeting by meeting and will be dependent on data and their impact on inflation and economic activity rather than a preset course. Okay, everybody, so I really want to make my thoughts clear and concise. So I have my notes right here, and I'm going to break down what I believe about this entire situation in relation to what Jerome Powell has said in front of Congress. Now, the first thing I want to say is that it's all about what Jerome Powell actually does at the FOMC meeting later this month, not what he says. Why is that? Because Jerome Powell has not said anything differently in this particular encounter with Congress than what he has said throughout these entire last 12 months, okay? Think about it. He has been saying that inflation is high and that they're focused on bringing it down to 2% and all of the things in that particular vein. Nothing has changed. So I'm trying to figure out, okay, what is he going to actually be doing at the end of the month? Another thing I want to say is that Jerome Powell is going to be paying attention to the jobs report that comes out, and he's going to be paying attention to CPI and PPI numbers that come out next week that measure inflation. So what he's saying right now in front of Congress is really irrelevant to me. It's all about what him and the committee actually does later on in March and what he says at that particular press conference. The second thing is this: even if he does raise interest rates by 50 basis points, the market is probably going to drop 10% as a result. But that doesn't scare me, and that doesn't make me feel any type of way. Why would I say that? Because the market normally corrects 10% in a given year anyway. So this year would not make this year any different than any other year. So I think that we need to just get used to it and just prepare that if Jerome Powell does bring the market down 10%, that's going to give you an opportunity to buy more stocks. And number 3, do not use what Jerome Powell says as a reason for you not to buy stocks at this point in time if you have a long-term time horizon and if you are playing the long game. I want you to think about this. We've already been in a bear market for the last 14 months. We've already went through all the crashes, all the corrections, all the interest rate talks. We've already been through all of the risk associated with this particular bear market that we are in. So, if it is your desire to build wealth and to grow wealth over the long term, what are you waiting on? You have to put your money to work. Nothing is going to change right now in the economy, right? At the end of the day, the media is going to continue to give us the exact same narrative over and over and over again. We have to have a long-term time horizon in the long game, right? We have to build our positions now and be ready for the long term before it's too late. I don't want us to wait 2 years or 3 years to say, hey, this is the time we need to buy stocks. No, we need to be buying stocks now while we're in this bear market, because when we get into the next bull market, that's when we want to be enjoying the fruits of our labor at that particular time. But we have to buckle down and we have to pay attention to what's going on in this particular market. So before we close this episode out, there are some things that I really want you to pay attention to and just keep in mind. Please stop trying to time the market, because time in the market is better than timing the market. Remember, ask yourself this question: are you trying to play the long game? If you are trying to play the long game, then now is the time for us to be building our position and trying to build our wealth. We need to be accumulating shares right now and continuing to find ways to accumulate more shares so we can purchase more assets. Another thing, we need to focus on increasing our income, reducing our expenses so we can, again, guess what? Purchase more shares. Income minus expenses equals free cash flow. That free cash flow is that amount of money that you have left over that you can utilize to purchase stocks, to purchase assets, things of that nature. That's what we need to be focused on. Last thing I want to say, please understand that now is the time for us to be putting in the work. Understand that wealth is a long-term game that has to be built. It's going to be difficult. It's not going to be easy. But if it was easy, then everybody would do it. Understand this. It's time to hunker down. We've been in this bear market for 14 months already. We understand the risk. We know what's going on. Put some money to work, understand what's going on, learn this game so you can be here over the long term and play the long game. As always, I thank you all for tapping into another episode of the Trade for Yourself podcast. Please like, please subscribe. Make sure you hit that notification bell so you can be in the know every single time I drop an episode. Please reach out to me in the comments. Let me know how you feel about this particular situation. Are you going to allow Jerome Powell to scare you out of your positions? Are you going to allow interest rates and all the risk in the stock market to continue to keep you away? Do you believe that the bear market is going to last into perpetuity, or do you believe that a bull market will be on the other side at some time in the future? As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all next week.